Q1, okay. So when you look at Q1 of 2019 versus Q1 of 2018, so our growth is okay, 17%. That is coming from, again, new stores. We did open 15 new Starbucks, so that's good. And we have positive like-for-like sales. They're not as high as we want, but they are positive. This is where we're seeing a bit of margin erosion. Again, maybe 40% of our total ingredients come from overseas, so we are subjected to exchange rate variations, so that's put a bit of pressure there. We're looking how to reverse that and do some tactics to engineer things so that we can get a bit closer to what we predicted. There's always ways of doing that with different menu management, different offerings that will help us to recover a little bit, and I think in April we saw a normalization of that gross margin. So we're happy that it's coming back. May also, we have enough strategies in place, I think, that the margin will be able to be where we predicted. We are also focusing on the bottom line, EBITDA and operating income. We have a lot of initiatives there that are helping in the middle of the P&L. From labor costs, we have to be very careful with the number of people we hire, so it's as efficient as possible. And rental costs, we again have to be very careful that we're negotiating hard with the landlords so that we can influence that middle of the P&L. So one of the other things that maybe has had a slight impact on our margin is the shift of the sales mix. There's a little bit of as you see the first quarter, the beverage has gone down by 1%, and others has gone up. Others meaning merchandise. When we're talking Starbucks, we sell a lot of the collectibles and merchandise. So there's a little bit of an influence there. We don't quite make as much money on the merchandise as we do the beverage. So we have to kind of still want to sell merchandise, but sell more beverages, and I think we have lots of creative ways that we're going to inspire that beverage category to stay at 66 is where we need it. If you look at our balance sheet over the year, there's nothing major there, but I think when you look at the top line of cash and cash equivalent, 2017, the 371 goes down to 280. That's 100 million. That was what we invested to buy Genki Sushi. That was an existing business, so we had to pay for that business, and that's why the cash has changed. If you look at the rest of the P&L, I think there's nothing unusual. The balance sheet, nothing that's unusual over a period of time. If you look at the sales growth, yes, we've early years, when you have less stores, it's very easy to grow at a very fast pace. But as you become higher in volume, that growth curve starts to plateau, starts to level out a little bit. So it's not unusual that 20 to 25% growth would be usual given the number of stores we have. So we feel that that is a reasonable number. We do benchmark against other businesses in other countries that have similar brands, and we feel that that is quite a good rate of growth. You see down, it's difficult to compare Q1 2019 because it's a bit early, but we do believe that that is a reasonable start to the year. We've projected around 23%, so it's probably likely, given history, we can catch up. We're not too worried about that.